Hello and welcome back to another weekend deep dive. My name is Justin, and today we're going to be going through and talking about how the bears are flexing, and there are some warning signs for the stock market bulls. And it is very important for us to understand that if this 454 neckline area does not hold, what are we likely going to do? We're likely going to go down. How far and how fast is what we're going to try to answer this weekend. And if, as always, if you're enjoying the video now or after the fact, I would appreciate a thumbs up. And please make sure to subscribe to the channel. We put videos out every single day. All right, so clearly this is a problem. And where I want to start is by just looking at two of the key indicators that are giving me some anxiety as a bull who was currently long, but starting to look wrong. So again, the first thing is just that we've now got 2 weeks where we poked above the 454 weekly neckline here. So that gives us a head and shoulders, and we're not holding it. So we poked above once, poked above twice. And what do we have? Well, last week we had a higher low and a higher high. This week we have the exact opposite, where we opened at, here we opened at 4538, and previous week we opened at 4535. We did not hold it either time. All we did was penetrate above and then lose it. So this is the ES chart. Same thing for SPY, just drop the number 448. So this is not looking all that great. And the reason why I think that there's still not confirmation is because we have dead cat bounced off the 50 MA, but it's not holding. So the current culprit is QQQ. And if we look at the last 2 weeks here now, where S&P was struggling with its neckline, which is all the way up here at roughly 385, roughly 383 on QQQ, we can note that it's not even able to get above its 50 MA. So it's currently dragging us down. And the last 2 weeks, all it was able to do is actually poke above this 50 MA once, poke above it twice, and put in a lower high and a lower low. So now we're below the short-term price, and this is not looking pretty. The reason I say it's not looking pretty is because the S&P right now is currently roughly battling for this area here. QQQ is notably lower. And the saying we like to always use is that chips lead tech and tech lead SPY. Well, if tech is leading SPY here, this is not pretty. It is not what we want to see. We're also getting some technical indicators on shorter time frames that do not look pretty either. What do we have here? Well, we've got a daily close below the 50 MA. That is below the short-term price on the daily chart. Reminder, we are already below the short-term price on the weekly chart. So QQQ is giving us a bad signal here if we are bullish. If we look over at S&P now, we also got dragged below and closed below the 50 MA here on SPYs. What does that mean? We're starting to look soft. Not all stocks are soft, but because the S&P is largely tech-driven, it's hard to ignore that if we're going to be going lower, that tech is going to be the culprit. So where I want to start right now is just looking at the options motivation first here, because next week is going to be a shortened week. So 3 out of the 4 days, we're going to have options. And I'm choosing to start here because I want to show that if the bears are going to be flexing, let's go back to the chart here and have a look. Then we'll go through our bull and bear thesis. If the bears are going to flex here, there's more than one reason why they would not want us to break bearish. First of all, people like me who are sitting on the side, who bought into the rally here, bought into the rally, are buying on the on the retest of the 50 MA. If that doesn't hold, I'm exiting. I'm hopping out. So the first thing is that if they start to lose control, meaning the bulls, we've taken roughly 11 points higher, roughly 4 points down. That's only about a third of the move. However, for people like me, this is my North Star, this 50 MA here. If we close below that, I'm hopping out, which means that they're now going to have to absorb all of the selling from the bears, and then people like me who are going to be exiting their long positions before they start going mega red. So that's the first thing. There's technical damage on the chart. The second reason is that there's a whole bunch of puts. So if the bears are really going to flex, we should see that into Thursday when we get the weekly close and we have options expiry for the monthly here. So again, like I said, the bulls should want to defend. And the second thing is that the bears should want to stomp. When we look here at the options chain for Monday, it's pretty busy. There's a whole bunch of calls at 450. There's a whole bunch of puts. I'm noticing max pain between 448 and 450. If we don't close in that area, it's an early clue in terms of who's in control. As we look to Wednesday here again, it's 448 is max pain, but it's a lot more muted because the next day is when we have the monthly expiry on Thursday, which is very unusual. We have Good Friday coming in on Friday. So here we have 450 max pain. And the reason why it's important is because as we look to the open interest here, we only have about 53,000 at 450 and then about 17,000 at 455. There is volume on the day. However, when we look over here to the put side, oh my goodness, right? If you're bullish, this is exactly what you don't want to see. We've got a 450, 440 call put spread, and there's no straddles, which means that people aren't expecting a violent move. They are expecting a bear move. We have 83,000 in open interest here at 450, and we got 121,000 over here at 440, which means the bears are motivated to stomp us lower. If the option sellers are in control, they should want to close this thing at 450 on Friday, which means we're going to be marginally green on the week if they're able to get to that max pain area. As we look forward here to the May monthly, which is going to be in 43 days, we note that, again, calls are muted. There's no volume at all. No one wants to buy calls. And in terms of open interest, all we have is about 23K here at 450, and they're worth about $9. On the put side, we see those same strikes feeding through here to this chain. We got 450, 445, and 440 with volume as well. So there is a bear tilt for continuation going into May. As we look forward to QQQ, it's mostly the same. So for Monday, we got 350 max pain with some calls and some puts, but 350 is max pain in my opinion. Wednesday's muted because, again, one day later, we've got the monthly expiry on Thursday. And here, again, 350 max pain. So those are the two areas that I really want you to be focusing on because there's more than one reason, like I said, to want to try to close the charts higher going into next week. It's avoiding the put payout. It's avoiding the put continuation into May. And as we look here to Friday, what do we have? Oh my goodness, right? A whole bunch of puts. So we got 108,000 here at 355, at 350. And then we got 87,000 in open interest here at 345 and about 64 and 57,000 in volume, which means they're continuing to build that put spread. Over here on the call side, it's muted. So we got 350 and 355, but it's not impressive at all. The bears are definitely flexing here and showing that they think we're going to go lower. This one here should actually be the QQQ monthly. My bad. There we go. QQQ May monthly. So I'm noticing some 352 calls with a break even of 355 because we got $3 in premium here, right? Not a whole bunch here, 24,000. And then on the put side, we see the exact same continuation we were noting on SPY. We got 350 down to 345. We already have the open interest or the motivation, and we got a little bit of volume here coming in to confirm it. So again, what's really important here is that SPY for Friday, the max pain is 450. Nice big round number. And over here on QQQ, it is 350 as the max pain. So let's look at those charts and see whether or not the levels are important. And this is going to be important as we go through to the rest of the video and tell you all about the reason why we're bearish and the reason why we're bullish. So here we go. Well, 450, first of all, would mean that we would likely have an inside bar from 447 down to our low of the week at 44350. That would mean that we should, again, depending on where we actually go on Monday, Tuesday, Wednesday, on Thursday, we would be closing out about right here, which means we would be closing inside the range from the previous bar. So if we push down and then we come back up to close Thursday here, that could be a bear trap where we're now closing out and now finally looking for that reversal higher. On the flip side, if we push up and fail to print another higher high and then close back down here, guess what that's going to turn into? An inverted hammer. It's going to look very similar to this one here. And if it's going to be red, oh my goodness, that is going to look terrible. The third week where we have what? An upper wick and leads to what? Usually a stomp. Look at the last time this happened in January, February, March, right? 3 back-to-back weeks with upper wicks, high, lower high, right? Slightly lower high again. They stomp it, right? That's when we had that big drop. So the warning sign's already there. We got a dead cat bounce off the 50, so that 450 area would make perfect sense for me. It's also going to be just above our 448.92 low, which goes back to late November. If you look at QQQ now, and we think about that 350 area, what would that mean? Oh, crap. That's like basically where we are right now. So the bull scenario would be that we open up, right? We push up, and then we test the 50 MA. And if we're going to close back at 350, that means that we're going to be getting hurt. Why? Well, it means that we're going to have another rejection here. We're going to have a pattern similar to here where we try to get above the 50 MA. We have a big old red week like we do right here, right? So, right, push above the 50, can't hold it, push above the 50 again, push to a lower low and close at the low like we did right here. And then what do we get? It's follow through, right? Try to go up and go down. Oh, crap, right? These bears are flexing and I don't like it. So I'm noticing that these two periods right here are what we could be seeing set up on QQQ. And there is a reason why QQQ is under additional pressure. So now let's go to our bull and bear thesis and see if we can understand what's happening here. So why bull or bear? Well, we can see here that for the bulls, we want to see that monthly continuation, which, by the way, right now we are not seeing. TINA, well, again, there's definitely TINA, but it's not TINA for technology. We're noticing that energy, utilities, and healthcare are all breaking bullish. Mike Wilson's playbook. For the bear case, we got more points now. Why? The case is getting stronger. So 454 being an impenetrable fortress, like we mentioned before, it currently appears like it will be. If we can't get above there next week, it's not a good look at all. Recession risk. Again, recession risk doesn't mean it's going to happen tomorrow. We're talking about like a 25% recession risk in the next 12 months, and then roughly 70% recession risk in the next 24 months, which means that it sounds scary. It's not something that's going to happen imminently, and it's not a guarantee that this is going to be the thing to move us lower, but it's on people's minds. We also have the geopolitical uncertainty to add to more. And then, again, we got tech leading the decline. That is not nice. If you're bearish, you're like, hell yeah, let's go. If you're bullish, you're like, come on, bulls, where are you? And then we got DXY and TNX breakouts, as I've been noting since last week. So the surprises would be CPI, Russia, and earnings. Let's just quickly touch on these, and then we'll move forward here. So looking at TNX, we can clearly see that there's a 30-year pattern going back to 1988. And we still have a lower high, but what's notable here is that we've actually breached and we're holding the 50 MA here. We're going to have to get a rejection like we did back in 2018 if we're going to get a move lower here. So again, to have interest rates go lower, the 10-year note. As of right now, we are breaking bullish and we're currently holding the 50 monthly moving average, which is not a good sign at all. This is going to add particular pressure to tech. And on the month, which is currently only about 8 days in, we're up 16%. That is a huge move. And then on the flip side here, we got DXY, which is going to add pressure to the overall market, but it'll be less specific to what we see in technology. Because when we're talking about technology stocks, it means that a lot of these companies are unprofitable, which means that they don't have earnings, they are growing. And the more expensive the debt becomes, it means that some of these companies are not going to survive. So TNX is going to impact QQQ more, which would explain the weakness on QQQ. And big dramatic move over here on DXY. What do we have? Well, we have 100 in sight. So we got a big W forming here, which is one of my favorite patterns. And as much as I want to say this is going to break down, it doesn't look like it wants to. It's building up pressure to the $100 area. It's already breached it at 100.189. And the reason why this is scary is because if we flip here to a monthly chart now, what do we have? Oh, no. We've got higher highs, potentially going a lot higher. So if we look here, even if we ignore like this range all the way up here to about 160, that is really high. We just zoom into, again, going back to 1988, which is the period that we have that 10-year Treasury note. We can see we got about 106 and about 121. So 106 would add about 6% more pressure to SPY. And over here, we got about 120, which would add about what? Yeah, about 20% of pressure to the downside. So if we start breaking bullish here, where's our targets? Well, they're higher than we are now. We're looking at about 106, and we're looking at about maybe 110 and 120. So if now we look at the S&P and try to understand that TNX is already dragging down QQQ, and now DXY could start to get some massive pressure onto SPY. Let's have a look here and see what those levels are. So if we move down by roughly 6 and then roughly 20%, where do we land? And let's look at a weekly chart because right now I'm mostly focused on the weekly levels. So if we look here again, about 6% lower, oh man, we're basically right back down to the lows. Yep, right back down to the lows. So we're right back down to the lows of the year, right? Roughly at about 410. If we now go down by about 20% from the current level, which means that at the peak, DXY would be at about 120, that would lead to a 20% decline here. Oh man, we're like really close to that 200 weekly moving average. Yep. And the reason why that's important is because we have done this dance before. I noted this when we were talking about the bear market thesis for 2022. And what do we have here? Well, right, bounce off the 50, can't hold the 50, reject off the 50, go to the 200. Okay, cool. Here in 2020, right? Bounce off the 50, bounce off the 50, bounce off the 50, can't hold the 50, go to the 200. Uh-oh. So again, the template's there. The warning signs are there. So this is not looking very pretty for us if we are bullish. But again, the purpose here is to know when we are wrong, and we don't want to stay wrong. So if we get that early evidence that the bears are cinching control, we got to repivot. We got to refocus our energy, and we got to raise some cash, period. TINA. So TINA here means that there's no alternative to the US dollar. And again, if there's no alternative, what does that mean? It's going to go higher. It's going to add even more pressure. In terms of the stock market, we'll look at that in a moment here. Pricing power with earnings season kicking off like officially on Wednesday with banks. Pricing power is going to definitely be coming through here. Why? Well, these banks lend money, and the companies are finding they have pricing power or they don't. It's going to mean their margins are going to be compressing or expanding. So we're going to get a really good pulse on the U.S. economy when these banks start reporting and finishing off by Thursday. The military. Again, I don't really want to talk about this, but in terms of the military, China is actually starting to build up their nuclear arsenal. They're talking about it because they're scared about Taiwan, right? They're scared. Nancy Pelosi was supposed to fly there this week. She ended up getting sick, so she didn't go. But China is now feeling some pressure. So we're definitely seeing that there's still no alternative to the U.S. in terms of military, but China's starting to feel a little bit threatened. And then politics. The world is united right now. And what that means is that the world's united, but it is not deterred Mr. Vladimir Putin at all. He is dead set on getting what he wants, at least as of right now. So in terms of the stock market alternative, we're going to look at this a little bit deeper when we go through the charts. But looking here at let's look at the last 1 week. Well, again, what do we note here? Well, we note that healthcare is doing good, consumer defensive is doing good, real estate, energy, and that's about it. That's the last 1 week. What's not doing so hot? Technology, as it's been evident by looking at the chart so far. If now we zoom out to year to date, what do we know? It's pretty much the same thing. What do we have? Healthcare, consumer defensives, REITs are pretty much flat, energy bright green, and healthcare bright green. Utilities also green here. So the trend of the last 1 week is basically just the trend of the last 1 year. And this is so important because as we look over here at the charts, we note that XLU getting what? A blue sky breakout, right? Boom! Crushing that red line, right? Crushing it. Nice blue sky breakout. We got 3 white soldiers. Oh, isn't that what we wanted on QQQ and SPY? Yeah, it is. So again, right, breached a new all-time high, put in an inside bar. There's the decisive break. There's the continuation. Bullish. This is what we were hoping for on QQQ. If we now look over here at XLV, what do we have? Oh my goodness, right? Strong price action. What do we have? We have a push to a new all-time high, and record close on volume. So healthcare is bullish too. And now if we look at energy, also breaking even higher. It's not at an all-time high. We got a golden cross. We're taking out fresh highs here. And we got movement up to about 85 and then about 90. So the 3 sectors, which are reflected here, is doing really well year to date. They're all in blue skies, except for XLE, which is at a 52-week high. So what does that mean? It will be easier for these ones to continue to go higher than lower. And on the flip side, if you look over here at some of the normal ETFs that we're looking at, again, let's look at QQQ. Well, what do we have? Well, we have a nasty setup here. What do we have? A rejection closing at the low of the week. That's a breakdown, not a break up. We're right on the pivot, closing below it. QQQ does not look good. If you look at the next one here, if we have a look at, actually, I think I'm going to come back and have a look at this when we get to the bull and bear case. So I'm just going to move forward here, get the rest of this out of the way, and then I'll try to wrap up here. Key dates. So in terms of key dates, what we have is going to be, right, we got Tuesday, we got the CPI. That is the biggest bolded text, which means that's the most important data point for me. After that, we got PPI, which is still important, but not as important. And then we got earnings season kicking off on Wednesday with banks. On Wednesday, we also have a BOC rate decision. And the reason why this is important is because it is a preview for the Fed. The BOC went by 0.25 at the last meeting. The Fed followed. So now, if the Bank of Canada does go by 50 or even 1%, meaning 100 basis points, which is currently the consensus, that's going to add pressure to the Fed and might be a preview for what we're going to see at their next meeting. On Thursday, we also have an ECB rate decision. And then on Thursday, we got monthly OPEX. Reminder that Friday is going to be a good Friday. The market is closed. And then we got big tech kicking off earnings the following week on Tuesday with Netflix. And then the rest of big tech reporting by the end of the month. So now let's have a look here at our base case. And I'm going to quickly explain what I'm looking for like I did before. So TINA to stocks. Well, as I explained, TINA to stocks does not mean TINA for technology. We can clearly see that healthcare, utilities, and energy are getting bid up hard. So in an inflationary environment, that's just where people are choosing to put their money. They're not investing. They're just not investing in the names that people who watch YouTube videos generally like to buy. Boring stocks. 454 is definitely still a pivot. And as of right now, the bulls are starting to flex. When we look at now, bulls and bears fight for direction. Right now, I would say there's no edge. S&P can be bullish even if technology is not. It's just fighting an uphill battle. However, QQQ cannot be bullish in the current environment. We're seeing more weakness. And what does that mean? Well, bullet number 4, confirmation is going to come after we hear from the banks, get a good preview on the health of the economy, and then also looking at what is going to happen for technology stocks by the following Friday, the reaction on the weekly close. So that's pretty much what I talked about for the base case. If you look at SPY now, let's go to here so I can actually draw on it. We look at our 1-week chart. Well, again, we got 3 colored lines on here. So we got a green line, we got a white line, and we got a red line. If you're not familiar with my videos, what this means is green is support, white is important, and then red is resistance. So as of right now, if we do close at 450 next week and we hold an inside bar, what does that mean? Well, it means we're in a period of consolidation. And then the following week would be the bull break or the bear break. So let's pretend we hold roughly the inside bar here next week. And then post earnings going into next Friday, we're below the 50 MA. What does that mean? That's a bear break. That's not good. It means the monthly is bearish. It means the quarterly chart is bearish. On the flip side, if we close at 450 here with an inside bar, and then the following week we break back above 454 and print a higher high, that could be the decisive move, like we saw where? Like we saw on XLV, where again, actually, let's go to XLU. Here's a perfect example. So, right, there's the move. Just pretend it's the move down, right? There's the price discovery. There's the advance. Here's the inside bar. So we're inside the bar. There's the break above the previous range. And then there's the continuation. So on the opposite side, the same thing can happen to SPY if we're going to break down. We're looking for something similar to this where we have an inside range and then the break on the following week. So that's what I'm watching for. If we're going to break bear, we should know either next week or the following week. And we're 100% going to have confirmation by next Friday. All right. So trying to get through the video a lot faster this week because I'm trying to mansplain less and give you the takeaways more, because I think this next week we've already done a really good job of laying out the bull case, and now we have to repeat the bear case here. So in terms of the bulls, like I mentioned, the bull case is that we need to see that the option sellers are in control and we close at 450 and 350 on SPY and QQQ, if not higher. There's not very much else for us to look at here in terms of the bull case. Why? Nothing's really changed for us. And now we're going to have a look and see whether the leaders are leading. Yes, they are, but not the way we want. They're leading to the downside, which feeds us through to our bear case. So the bulls have XLU, XLE, and XLV to look to. The bears have a lot more in their arsenal right now. Let's look and see what that is. So as we go forward here, where I actually want to go now is going to be to the heat map. And as we noted, again, we look at year to date, we look at the last 1 week, it's pretty much more of the same. So if we were seeing window dressing going into the end of the quarter, that's pretty much all been unwound. And this is the Mike Wilson playbook, right? Healthcare, utilities, REITs, defensives, that's what he's been talking about. He wants to see them move down to 400 to have direction. I would also note that we've been bouncing steadily between neutral for quite some time now. Since we got out of extreme fear, we've been having a hard time getting a decisive move by either getting back into greed over 56 or falling back into fear below 45. But I think that the next move is going to be decisive. Again, the charts are not giving clear direction, and that's why I say there's no wedge. The fear and greed index also flashes that same morning here where we're actually stuck in a range of neutral, which means the market's not fearful or greedy right now. It is stuck in the middle. Now, if we have a look here at what has been driving this weakness, what I want to show is that the flip side to what we noted on XLU, XLV, and XLE, meaning energy, utilities, and healthcare, we're noticing the exact opposite over here in, let me actually get my notes over here for 1 second. Here we go. Get my notes because I have these charts prepared. All right, ETFs and indicators. So I got through those ones. We went through the bull ones. Now let's go through the bear ones here. And these are already all drawn. So my point was that if we look at XLU, it busted over the red line. XLV busted over this. This should be a red line here. That's the resistance. And then looking at energy, it blew through the previous red line, now revised to a red line, to a green line. Sorry, why? Well, it didn't double top. It actually kept going higher. Now let's have a look at some of the other ones. So we got QQQ here, right? Rejected off the white line. Couldn't even make it to the red line. Yuck. That's not nice. Next one we're going to look at is going to be XLF. So XLF, what does it got? Well, it has an inverse head and shoulders, but it's below the 50 MA. That doesn't look so pretty either. Now we look at DIA, where the Dow was actually pretty muted, right? Second doji, not a lot of volume. That makes sense. It's not hurting or supporting SPY. It's basically down by 0.18. Pretty impressive. Now we're going to look at some stinkers here, right? We got the Russell. So the Russell is down by almost 5% on the week. It looks terrible. It looks terrible. It looks terrible. It looks terrible. Now we can look over here at ARK, right? An amplifier for IWM. We got elevated volume, right? So strong volume, but stronger price action. That's a nasty bar, down by 10% on the week. Yuck. Next thing we're going to look at here is going to be where we can note that we're not seeing weakness. So on the NYSE, we're down by basically 0.5%. We're holding the 50 MA with a hammer. So the average stock in the New York Stock Exchange, and by the way, there's 2,000 of them, is actually holding up pretty good. We can also look at RSP, which is equal weight S&P 500, which means we're giving less weight to technology stocks. And we note that same pattern here, where we're bouncing off the 50 with more of a hammer than not. Right, TNX already broke bullish. VIX is also basing here, and we can note that it's right around 20. It's just above 20. It's actually green on the week, and it's holding up here. We can also look at gold versus crypto and note that gold staged a pretty nice move this week, right, up by about 1.1%, and then NYXBT or BTC on the reverse side is down by 5%. Technically still trending up. It broke the blue triangle here. It's having a really hard time at 47. It's back below the 50 MA, and this previous high going back to January of 2021 is the really important area for me at roughly 41.5. We've tested about 42,000 so far. So if we come back below, again, not a very good look either, because we're already seeing rotation into gold versus BTC, even in an environment where we have the dollar rising to 100. So that's important. But now what we're going to do is we're actually going to do a deeper dive on the technology sector, because we noted that if the leaders are leading to the upside or the downside, we can't ignore it. So here I'm talking specifically about Tesla, Amazon, Facebook, Google, Microsoft, Apple, Nvidia. So let's go through those. I'm going to go through in the order of just their market cap size. And let's go forward here. So first one I want to look at is going to be Apple. So Apple is below the red line. It is back testing a key area here at roughly 165, back testing its breakout. This is the only one other than Tesla, which is showing some true resilience. So when I talk here about Tesla as well, I'm noticing a massive cup and handle forming here. Let me zoom in a little bit closer. So massive cup and handle, and right, still holding 1,000. It's back to the real body from 2 weeks ago. We could push down as low as 955 and still maintain a handle, but pushing down to roughly 900 means that we're invalidating the current cup and handle. So again, not sure what's going to happen, but these two look the strongest. After this, we got Microsoft, which is a really large company. What do we have? We have a hard landing back on the 50 MA, and we are back below the red line. So this is the opposite of what we noticed on the other sectors. Again, energy, utilities, and healthcare. So this looks like it's a head and shoulders now, right? Lower high, lower low, hard landing on the 50. It loses the 50. Another hard landing, probably back down to the green line, or a repeat of this last week. Not pretty. And Microsoft should be able to shrug this off more. So when it's not, I'm listening and paying attention. Google, hard landing, not only on the 50, but below the 50, back testing the breakout and back below the red line. Not pretty at all. Let's look at Amazon. Amazon, what is it? Yuck. It looks just like QQQ, right? Double rejection on the 50 MA, stomped, and back below the red line, back below the pivot. Looks like it wants to shoot down here to roughly 2,800. Not looking pretty either. Now let's look at Facebook. Facebook's not terrible. We have an inverted hammer and a rejection off the 200 weekly moving average and the relative low. It's stuck in a range. It's not as bad as the other ones, but it's already given its fair share of stink. So, right, not being terrible is not really all that impressive either. And then Nvidia, if we're talking about chips leading, right now, Nvidia is leading to the downside. It's down 13% on the week. It got drilled at the red line. It stomped all the way down and hard lining on the 50 MA. This does not look good either. It's leading to the downside. If you look at something like an AMD as well, yuck, right? Head and shoulders off 122, close below the 50, and then reject off the 50. This is exactly what we don't want to see if we are trying to be bullish. So these bears are 100% flexing, and all we need is just more continuation, and then it becomes a self-fulfilling prophecy. Fed minutes on the balance sheet. Well, again, if you don't know what happened yet, they're talking about balance sheet runoff at 2 times the normal rate and doing $95 billion a month, which is going to be the equivalent of doing more interest rate hikes. And then Goldman Sachs on Thursday or Friday, I forget, I think it was Thursday, talking about how actually we're going to have to go to 4% interest, not 3. Forget about 3. We're going to go to 4. So again, the quivers in the in the bear camp are starting to get stronger. So not 100% sure here. And the reason why the Fed balance sheet matters is because we know the stock market has a really hard time to rally when we see balance sheet runoff. So they're going to do it at 2 times the rate of 2018. What are we going to get? 2 times the pressure on SPY. Cannot ignore it. In terms of our bear market targets, we haven't really hit very many of them either. So these are all not all necessarily in 2022. And we can hit those lower levels when we go into recession in either 2023 or 2024. All we've been able to do is basically get down to about 410, not quite to 400. So the key area that I'll be watching here, these are old levels. So our 50 weekly is now curled up to roughly 442, 443. I'm looking at 432 or that 10% drop here. So if we go back below 432, it's almost inevitable that we're going to go down to 400. What's going to drive it? Probably DXY, probably TNX, probably technology dragging. No guarantees though. And then as a reminder, this is the bear market thesis where 600% from peak to trough over 149 months. We went for 154. We've not put in a higher high, which means that we're still within the range that's been established. If that's our relative high, it's time to go down now. How much? 50%. And it doesn't happen all at once, right? Go down, dead cat bounce, go down, dead cat bounce, go down, dead cat bounce. So if the recession is going to come in 2023 or 2024, that could be where we are actually legging down. We can stall out here for multiple months. And then again, the rooster comes home later. So now what I want to do is go and have a look at S&P with all this information and understanding of what is happening. Let's look and see what is happening with the S&P specifically, because this is the most important chart for me. And what we have to keep in mind is that the S&P accounts for more than just technology. So there's more than one way to make money in the market. Just because the market's going lower does not mean you cannot make money. Again, buying XLU, XLE, XLV, you would be green on the year, not red. Why? They're all making relative new highs, either all-time highs or 52-week highs. So the first thing I want to point out here when it comes to SPY is just that we don't have a green open. And the reason why this is so important for me is because my thesis was that we were going to be getting no lower wick here on SPY like we did in 2018 and like we did in 2020. Pretty hard to argue this is not becoming a wick. So even if we reverse back up now, we're going to be leaving a big old tail on the bottom here. We did not do that in 2020. We did not do that in 2018. So if this is the start of us going lower, it's just the start. And it's not a good start. Why? Well, it looks like we got a rejection here with a head and shoulders at 454. It's what it looks like to me. Looking at it with fresh eyes, not what I want to see. This is exactly what I didn't want to see. We're also closing at the low on the weekly close, which means there's pressure building up to the downside. That's not good. Not at all. We look here at the monthly chart next. And again, the monthly chart feeds through to the quarterly chart. So before we get confirmation we're bearish on the quarterly, the monthly chart's going to flash a warning. And right now we got it. We were looking for our IHS level to hold. It isn't. We got 448.92. And over here, we've poked below and we're closing below on the weekly. So the most important thing to keep in mind here for the bear case is that if people bought the dip in December, January, February, March, and now they're regretting it, what are they going to do? They're going to sell. They're going to sell back. And that could be that all this buying pressure from 4 months is going to get unwound. And people like me, like I said, are going to be looking to sell before we break down and start the plunging. So I want to trim before I need to be forced to sell. So the monthly chart right now, we got to get back above that 44892, like in a hurry. So that 450 max pain going into Thursday is going to be especially important. Looking here at the weekly chart, still technically no damage. We can note here that we got our big push in volume going back to our week here, which is the last week of January. So where's our high? Almost perfectly where we're bouncing off of. Our high here is 444, and that's where the biggest volume comes in. So if we fall below the top here, people are not going to be just giving back the profit they made. They're going to be going back down to red. Are they going to want to hold on? I don't know. So again, we're right here. We got a back test. We're right on the anchor VWAP to the all-time high or beginning of the year, and we bounced off the 50 MA. If we print a lower low, we're going to be printing lower than the 50 MA because it will be curling up, and that is exactly what I don't want to see. This also looks quite different than RSP because it's more of a spinning top. It's not a hammer. Why? Technology. It's dragging us down. So now that's the weekly chart, right? See some more warning signs here, but no concise, clear break yet. We're not going down. We're not going up. What are we doing? We're solidly going sideways. And as of right now, we technically do still have a weekly inverse head and shoulders. So I wouldn't say that it is down and out yet, but the evidence is building up that S&P might not be able to shake off this current downturn. And yes, this is not a perfect inverse head and shoulders here. Why? Well, our neckline is actually over here to 44892. But remember, the pattern we're looking for is it close enough? Not, oh my God, it breached 44892. It's invalidated. No, those are called breaks. And what we have to keep in mind too is that we're battling for daily levels right here. So after we can't hold the 200, where do we go? Well, probably back down to the 50. All I'm trying to say is that we're looking to see whether or not the pattern is clean enough to say it's holding. Yes, well, didn't hold 44892, but it held the 50. If we now fall below the 50 MA and below the white line and 440 psychological, hard to argue this is an inverse head and shoulders. That's a bull trap. Okay, becoming much more clear now. Now, if we look at the daily chart, here is where it gets a little bit more confusing because the daily chart still actually looks very constructive. Why? Well, it looks like a massive cup and handle. So price is king for me. Price is number one. Price is all that matters. Why? Price is what people are willing to trade it at. The volume confirms the move, and the moving averages help to support the thesis. So in terms of SPY, it's definitely doing better than QQQ. We have a W inside of here. If it's truly a win, we cannot stall out anymore. We have to go back up. And this soft landing here, gap's been filled. It's healthier. It means that this should be the bottom. We should not be going any lower. And if we're at peak hawkishness, truly, we should be resuming back up higher here. So if we don't, something's wrong. And we have to recognize that early. The cup and handle is going to be breaking down, and it's not looking all that great. Last thing here is just the volume. So ever since we had this big push off the bottom here and that power move, again, big red bar, one big green bar to kick the move off, and then muted. All we have here are red bars, which are back to the 50 MA, going back to the 31st of March and then to the 6th of April. So, right, the bulls are not buying it up here. All they're doing is defending. And we look here on the hourly now. Again, we were going up. We were going sideways. Now we're definitely going down. That 456.6 is really important too because it is a January low and the February high. So, was support, became resistance, false breakout, still resistance. Again, rejected here on the 5th of April. And now we're in a solid channel lower, or these blue lines. So what does that mean? The path of least resistance right now is down. If we're going to get a decisive break higher, that should be coming right here going into the early part of the week. Why? Well, look, if we can stop going down, there is a chance we can go back up. When does that happen? Well, we got a big tester going into noon on Monday. Again, before that CPI print. So if we're not higher going into the Tuesday open, meaning back above 4489, 44892 to be specific, it likely means that this is a sell the news. So it's not good at all. That is all that I have prepared for this weekend. So trying to make sure I provide the videos as short as possible with as much value as possible. So if you want to know more about my bear market thesis for 2022, there will be a video that queues up here in a moment, and you can go ahead and watch that one. Otherwise, I wish you all the best of luck for your trading this week. And remember, we do daily videos every single Monday to Friday. I encourage you to subscribe to the channel and come back and watch for updates. Thank you and good luck.